Hey, everybody. We've had overwhelming interest in taxation topics, so we've launched our CPA Corner. I bring in specialists like this one, Alex Evers. He's an enrolled agent specializing in personal taxation. Great videos on very interesting topics. This is where you're going to learn personal taxation. As always, visit yourinvestmentcounselor.com if you want to meet with any of us or anybody on our team. Yourinvestmentcounselor.com. Without further ado, here you go.
Hi, everyone. My name is Alex Evers. I'm an enrolled agent tax advisor with McEvoy Toll CPAs. And today I'm going to be discussing net investment income tax. So just a little example or background here. Net investment income tax first showed up in 2010 with the passing of the Healthcare and Education Reconciliation Act. This was originally designed to apply to individuals with a higher modified adjusted gross income and who also had investment income. So what is investment income for the purpose of the calculation of net investment income tax? Most passive income is going to be subject to net investment income tax. Just so you're all aware, the net investment income tax percentage is a flat 3.8% on any investment income that exceeds your modified AGI threshold, which I'll cover in a sec. Just some more examples here. Gains from sales of property such as stocks, bonds, mutual funds, or real estate is subject to net investment income tax. Interest, dividends, certain annuities, rental income from a property that you're considered passive in, meaning you don't manage a property, you're not making any day-to-day managerial decisions. Maybe you have a property management company running things. That income is subject to net investment income tax as well. Say you're a silent partner in an LLC, or you just made an investment in an S corporation when it first opened, and you don't really have much to do with running the business. That's going to be considered passive income and subject to net investment income tax as well. So really, if you want to group it all together, income that's subject to net investment income tax is income that's really just working on its own in most cases, with the exception of IRA distributions. Social Security income is exempt as well, and obviously earned income such as W-2 wages, or if you own your own business and you're working in the business every day, that's earned income and not subject to net investment income tax. So these are the modified adjusted gross income thresholds I mentioned. So it depends on your filing status what your threshold is going to be. But if you're married filing joint or a qualifying surviving spouse, your modified AGI threshold, is $250,000. So what does that mean? Your modified adjusted gross income, if you are below $250,000 filing jointly, and that any investment income you have is not going to be subject to net investment income tax. Same goes if you are married filing separately. If you're below $125,000, you're not subject to any net investment income tax, and $200,000 is the threshold for single or head of household filers. Here's an example just to paint a picture for you. Mary and John are filing joint. They have W-2 wages of $150,000. And in that same year, they decide to sell their house, and they're looking at a $200,000 capital gain. Well, now their modified adjusted gross income is going to be $350,000. So here's a quick example to show you here. This is the 8960 tax form, which will be the form that shows up if you have net investment income tax. So line 12 shows all of their income that's considered net investment income. That's their $200,000 capital gain. Their modified adjusted gross income is on line 13 at $350,000. And then what you do is you take what your threshold is, and in this case for Mary and John, it's $250,000. You subtract that from your modified adjusted gross income, and you end up with income that is actually going to be subject to the net investment income tax. So in this case, they have $100,000 in net investment income. That's going to be taxed at 3.8%. So they're looking at an additional $3,800 when they file their taxes. Just something I want to point out on this slide, long-term capital gains tax brackets are 0, 15, or 20%, depending on your taxable income. I wanted to point this out. I've had a number of clients call me and say, "Hey, I'm selling my house. I know I'm going to have to pay 15% in capital gains tax." Well, depending on your taxable income and your AGI, you might be at 18.8% or even 23.8% for taxes being owed on just this property sale. So just something I wanted to make you all aware of. If you decide to Google long-term capital gains tax, what the rates are. A lot of times it can be misleading because you'll see the brackets being at 0, 15, 20%, but it's not including net investment income tax, which really shows up a lot when you have a considerable amount of capital gains. I want to talk about some tax planning for this type of tax when it does show up. Best thing you can do is reduce your AGI below those thresholds that we covered so that you're not subject to this additional tax. And there might be situations where you can't do that. If you have interest income, there's not really a whole lot you can do to reduce your AGI unless you have losses from your business or whatever. But a lot of times you might just have to pay estimated taxes. If that's the case and you're interested in doing that, that'd be something you talk to your accounting firm about, or you talk to us about that, and we could project out what your income is going to be for next tax season, give you the appropriate vouchers to pay estimated taxes, and that way you're not going to be subject to any additional penalties for underpayment of taxes. For the most common thing I see is property sales, home sales, where there's large capital gains. Tracking your home improvements will help offset some of these gains because you can kind of add that into your cost basis. If you are able to, maybe short sell some stock that's not doing too well, that will be a capital loss for the year, and that can be used to offset capital gains as well. So it depends on your situation, but there can be a couple of things done. One more example for you: if you have that passive rental property that I mentioned earlier, and you're seeing a lot of income come in from that, purchasing assets for the property, making improvements to the property, that can be depreciated. That'll increase your depreciation expenses, which will lower your net income on that investment, which will end up reducing your AGI and hopefully reducing your net investment income tax. So just to help clarify that, I'm referring back to the same example with Mary and John. So they're still at they're at 350,000 AGI. They have $100,000 in capital gains that's subject to net investment income tax on top of the 15% that they might already owe in capital gains. So let's say they paid $30,000 in closing costs and commission to their real estate agent when they sold the home. That can be used to offset their capital gains because it's additional costs when they sold the property. So that can be used as an expense. And another example is if throughout the time they own the home, they made $45,000 worth of improvements to the property. So now they have $75,000 in additional costs that can reduce this capital gain and reduce their net investment income tax. Another thing they decided to do was sell stock that wasn't doing too well. So they have an additional, capital loss that they can kind of offset this gain with. So now, using those numbers, we refer back to the 8960 or the net investment income tax computation. Now their capital gain, which is considered net investment income, is at 119,000 as opposed to 200,000 originally. So now their modified adjusted gross income is lower. They're at 269,000. So again, doing the same thing, you're subtracting your threshold from your modified adjusted gross income, and their income that is subject to net investment income tax is 19,000, much lower than the original 100,000 that we showed in that previous hypothetical example. So now they're looking at much lower tax, $722 compared to $3,800, and that's just from recording your closing costs and making sure you track your home improvements in your property. So there are a couple of things that can be done here. If you are interested in figuring out if you are subject to net investment income tax, we can certainly help with that. Our information is right here. Please give us a call. Look us up online. We love doing tax projections before the end of the year to get ready for the busy tax season. So I hope you all enjoyed the video. I appreciate it, and there will be more coming very soon.